It's not so much on them as it's a secondary effect on them, because what should happen if that one key asset that people are only now recently noticing and a little nervous about, not panicked about, just nervous about, the T-bond market, not corporate debt, government debt, long-dated government debt, 10-year, 30-year. In stock market wobbles and tops, beginning of bear markets, which usually is hardly ever a sharp decline. It's usually an arm wrestling, deceitful sort of event where people aren't sure it's really top. It's just a correction, et cetera, like 2007 was. It wasn't until mid-2008 people finally realized, gosh, it's really over. But during each of these bear markets in stocks, even at the onset of, if you go back and look at two assets that did well, it's the stock market, it's the gold market and the T-bonds. They were alternative places to be. And this time they tried to do that. If you'll notice back in late March, early April, and we were frankly looking for a T-bond rally. That might last a quarter or so as an alternative situation, meaning a rise in price, lower in yields. And it started, in fact, in early April, they shot T-bonds up from the 1-teens, 30-year futures I'm talking about, up to 122 on T-bond. Huge shot up. But within 2.5 days, it crashed back to 111.5, where we're trading around now. Okay. Why? Why did T-bonds crash? They're an alternative. Gold didn't crash. Gold had a 5-6% drop and then immediately back up. It didn't make sense. I think what's going on is finally, after decades of knowing what you just talked about, that we've got a problem that can't be wished away, the government debt problem. And it's getting worse all the time, including under Trump now. We know the debt's going to be higher, et cetera. Sooner or later, that reality will have a consequence, of in that market, the bigger asset market than the U.S. stock market, the U.S. government bond market. And if it does, that's almost beyond the control of the Fed to control. They influence the short end of the market. But when that long end of the market goes crazy and starts to pay the dues for decades of error, compounded error, what the hell's going to happen? I mean, both with government panic, public panic, interest rate wave effect in certain stock market sectors. For example, why does MSA pay so much attention not just to the tech stocks that everybody looks at, but to commercial real estate? RWR, VNQ, two big ETFs that express the commercial real estate market, or watch the financial sector, because we know that the debt issue that's accumulated there ultimately will have to be paid. And I understand a lot of it's coming due in 2025 and 2026, commercial real estate. If it doesn't get paid, that means some financial institution on the other side of the equation is going to get gut kicked. And suddenly that's going to be a headline. So anyway, this is what's going on. And I think it's an ongoing process, and it will ongoingly help gold and silver and the miners.
Yeah.
And for some reason, this time, not the T-bonds, which narrows the field of the outperformers. Yeah, all the corrections that we've had, and there's a chorus of people on the internet, these free internet financial advisor types, who have called for a top in gold repeatedly and or a major correction in gold repeatedly over the last couple of years, especially since it woke up in 2024. In March of 2024, gold was back up to 2,000 for the fourth time. And we said, this time's different. It's going to explode. And it did. Silver did too. Silver was $25 then. Gold miners were 31.5 on GDX. They're now either side of 50. So they exploded. But during that process of more accelerated advance, not full acceleration, but more so than before, there were sharp corrections. But none of them went back to the orthodox level where you as a price chart technician might say, oh, we need to pull back to 2,800. Why? Well, because that was a prior major shelf. So we pull back. None of them ever go back to where these guys say it must go back to. And so there's this constant underlying panic in the gold market among those who own it and the miners, et cetera. That, oh my God, it's either the top or two, it's going to correct big. And it never does what they say. It always teases. You get like a 5 to 10% drop in gold. And then next thing you know, you're back at the high again.
All right, let's really dig into what's going on out there. Because frankly, the landscape we're looking at is unlike anything we've experienced in the modern era. And that's not an exaggeration. I've been at this a long time, studied centuries of market behavior, and I can tell you outright, this time is different in some fundamental ways. Now, you've heard me say many times that silver is probably the biggest bargain in our lifetimes relative to gold. But it's more than that. It's the sheer asymmetry of the setup. If you roll the clock back 50 plus years, there have only been a few moments where the gold-silver ratio has looked this distorted. And every single one of those moments was followed by a violent catch-up in silver. What's even more telling to me is that this is precisely how these long commodity cycles usually evolve. They're sneaky. They build slowly, they shake people out repeatedly, and then, typically toward the end of the secular run, you see silver absolutely detonate on a percentage basis. That's when everyone piles in, long after the smart money has loaded the boat. If you look back at the late 70s, silver didn't really start to move until the last 18 months. Then it quadrupled. In 2010 and 2011, same thing. Silver lagged gold for much of the run. Then suddenly it rocketed from $17 to nearly $50 in no time. It's textbook behavior. But here's the kicker that's lost on most people. This time, the macro context is radically different. We're not living in an environment where Paul Volcker can come out and jam rates up to 20% to protect the dollar. Those days are long gone. If Powell tried that today with $35 trillion in debt, the entire fiscal structure of the United States would blow sky high. Interest payments alone would consume every bit of tax revenue. So forget about the Fed cavalry riding to the rescue. This time they're riding Shetland ponies with nowhere to go. And that's exactly why I believe when silver explodes again, and I'm convinced it's on the cusp of doing so, we won't get the same 1980s-style crash that follows. Instead, we're probably looking at a complete repricing of what money is, a structural reset. Now, there's another piece to this puzzle that I don't see many people discussing, and it's critical. The T-bond market. That's where the real systemic risk is brewing. Everybody obsesses over stocks, and sure, equities will crash. But the stock market isn't the center of the financial universe. The government bond market is. The U.S. Treasury market is bigger than the stock market by orders of magnitude, and it's the collateral base for the entire global banking system. When that thing wobbles, everything else becomes peripheral noise. And guess what? It's wobbling. Back in late March, early April, you could see the market trying to play its usual games. Stocks were acting heavy, so the flows went into T-bonds, trying to treat them as the safe haven. In fact, we even expected a short-term rally in long bonds, purely on rotation. And sure enough, they tried. The 30-year futures shot up from the low 111 to 122 almost overnight. Massive move. But you know what happened? Within just 2.5 days, that rally collapsed, right back down to where it started. And that is not normal. That's the market quietly telling you, we're not buying this old safe haven narrative anymore. The trust in the long end of the U.S. debt market is breaking down. Gold didn't collapse. It dipped modestly, 5 to 6%, then snapped right back. Meanwhile, T-bonds cratered, and think about what that means. For decades, whenever stocks buckled, money would flee into treasuries. Now you're seeing the beginning of the opposite. Investors don't want that risk anymore because they know the debt math simply does not work. The U.S. has layered error upon error, decade after decade, compounding it until finally it's mathematically irredeemable. And the market senses this. You can't hide from gravity forever. Sooner or later, reality asserts itself. This is why I keep such a close eye not just on equities generally, but on specific sectors like commercial real estate. Because that's the epicenter of risk. You look at VNQ, RWR, those big red ETFs. There's hundreds of billions tied up there. And a ton of that debt rolls over in 2025, 2026. If that can't be refinanced at cheap rates, which it won't be, then some financial institution is on the hook. And that's going to be the big shoe to drop. Same story with regional banks loaded with commercial property exposure. You think we're done seeing bank failures? Not even close. And that's why I say this coming storm isn't going to be just another cyclical downturn. The consequences are going to be profound. They're going to fundamentally change what people view as money and where they want to park their savings.
Silver has a different structure, but silver relative to gold is right now probably the biggest bargain in lifetime. If you go back 50 plus years and look at what silver price was compared to gold, it's It's at one of the lowest levels it's ever seen, and it has the technicals to reassert itself, meaning it ain't going to stay here. And it looks like it's about to. Now, when this occurs, if you go back in the prior major bull markets, you'll see that, especially in the latter year of the bull market trends, that's when silver especially exploded versus gold. Whereas during much of the bull trend, it was either on par with or underperforming gold in terms of the better place to be. But in that last year, silver suddenly goes berserk on a percentage basis. And we see that likely to occur now. I think it's going to be different this time. I've said this on a couple different interviews recently, is that while we go into an acceleration phase, which I think we're about to, especially noticeable in silver, but not so much in gold this time, that used to be associated with the final handful of quarters in the bull markets in 1980 and in 2010 and 11. Okay, so we say, well, that means we're going to top again. Well, this time I think there's a different reality out there, both a macro, technical, and fundamental reality. And that is, this time when we go through this next crisis of a given asset category, specifically especially the U.S. stock market, and also likely a potential crisis in the U.S. government bond market, that the outcome on the other end is not simply going to be, well, it simply priced itself down, stock market down enough to where it's cheap enough to go up again, and there's a wipeout. This time, I think the consequence is going to be of monetary policy globally, where there's a shift in the world among central banks, which may or may not exist after this is over in terms of their acceptability, where we shift to real money. We shift back to gold, where, the currencies are not backed by nothing, but they're backed by gold. And I think that this crisis that we're about to face, which will be exhibited in the stock markets, especially in ours, and potentially in the bond market, will cause that kind of outcome, such that when the next time you get gold up to some high level where you think, oh, it's the top, it might be the top, but it doesn't necessarily mean it's coming down. I think it could just be a new reality where suddenly we shift out of fake money. How else do you define it? It used to be, at least the dollar was backed in international transactions by gold, but Nixon even ended that. Roosevelt ended the domestic side. So you got nothing but pieces of paper that are hanging on my wall behind me there, and that's where they should be hanging. The reality, once the crisis hits, there'll be enough people, and there already are some in the academic world, that once the crisis hits, they'll say, listen, this hasn't been working. And it's not like this central bank game has been underway for centuries and centuries. It's been underway basically for a century. One very long human lifetime, we've had the Fed. And even some of that time, we had gold-backed currency. And now we have nothing but fiat around the world. Well, when that crisis hits and the real world effects of that error are exposed, there will be some folks, and maybe even the public, that recognize, what, I don't want this stuff in my wallet. Give me something stable I can count on its value. And there will be an upheaval, a revolution, if you want to call it that, in the monetary world, where we don't have from above definition and production of money.
Now let's dig into why I keep saying this time is categorically different. Why I don't think we're just going to replay the 1980 spike and crash or the 2011 peak and plunge. You see, in every prior commodity blow-off, there was a structurally sound alternative for capital to flow back into. In 1980, Volcker could crush gold by jacking rates to the moon because the US debt load was trivial relative to GDP. The cost of servicing the debt didn't matter. The US was like a fit 25-year-old athlete taking on a little extra cardio. It could handle it. Even in 2011, when gold hit $1,920, the system was still largely intact. The Fed had just run the first big QE experiment, and the belief that it would all normalize was still widely held. People thought, well, we'll get past the GFC, we'll hike rates, we'll shrink the balance sheet. Of course, that was fantasy, but it was still credible enough at the time to short-circuit the gold rally. People thought we were going back to the old normal. But today, the fiscal condition of the US and Europe isn't just weak, it's catastrophic. The US is running $2 trillion plus deficits at full employment. Imagine what happens when we hit a real recession, and we're about to. The Congressional Budget Office projects $50 trillion in debt by 2033. That's under assumptions that are already laughably rosy. What happens when they have to bail out pensions, bail out commercial real estate lenders, bail out student loans, bail out everything? Those numbers go vertical. So let me ask you this. When the next recession arrives, and it always does, how exactly does the Fed tighten to kill a gold rally? They can't. They'll have to monetize like never before. And that's not just my view. Look at what Larry Summers and Ken Rogoff have been saying. Even the old Keynesian stalwarts are publicly admitting we're headed for a debt spiral. And this is why I keep hammering the T-bond story. It's the third leg of the stool. Stocks break down, bonds are supposed to rally. They're the risk-off asset. But what if bonds fail? What if the supposed safe haven is no longer safe because people realize the issuer is insolvent? We already got a preview in March-April. The T-bond market tried to play its old role, then crashed right back down. Gold dipped briefly, then surged again. That's the tell. If T-bonds can't rally in the next downturn, if instead they become part of the panic, where does all that capital go? It's not going into corporate bonds. It's not going into private equity. It's going into the only asset that's no one else's liability, gold and by extension silver. And this is where things get truly explosive for silver. I said in part 1 that silver is historically cheap versus gold. Right now, it takes roughly 80 ounces of silver to buy 1 ounce of gold. In past secular bull markets, that ratio compresses to 30, sometimes even 20. Do the math. If gold's heading to $8,000, which would just match its prior 8-fold moves off major cyclical lows, a 30-to-1 ratio means 266 silver. But even without extreme compression, just reverting to a modest historic norm puts silver triple digits. And I'd argue this time we're set up for even more compression because the monetary system is more broken than ever, and the industrial case for silver is simultaneously off the charts. EVs, solar, electronics, all pulling on the same supply. Now people say, well, silver's volatile. Yes, that's the whole point. The volatility is your friend if you're positioned early. Volatility is how the bull market tries to buck people off before the real move. And you're seeing all the classic signs. Think about the pattern since last year. Silver hits $32, drops to $27, pops back to $35, drops, then right back. We've formed what looks like a multi-year cup and handle that's just now breaking out. This is technical textbook stuff. Once it clears that $38 to $40 band with conviction, there's very little overhead resistance until the old panic highs at $50. And that's fragile resistance at best. Vince Lancy, who's about as sharp a metal trader as you'll find, tweeted recently, "Silver is where gold was 18 months ago. Long base built, liquidity traps everywhere, then sudden vacuum to the upside. Wait for it." He's spot on. And remember what I said about momentum versus price? The most interesting part of this setup isn't even the price. It's what the momentum oscillators are showing. We've had 12 plus months of momentum cooling off while price held in a range. That means there's a huge amount of pent-up energy. The minute silver closes above roughly $34.95 on a weekly basis, you could see it catapult. I'd wager the first leg alone could double the price. Not eventually, within a single quarter. That's how these things work. It's why I keep telling people, get positioned before the fireworks, not after. Now let's layer on what's happening globally, and especially with the BRICS. It's become fashionable in some Western circles to dismiss the BRICS as a joke. Oh, they're too disjointed, they'll never coordinate. Well, tell that to the Shanghai Gold Exchange, which is now the largest physical gold exchange on the planet, or to the UAE, which just signed on to the BRICS Plus Payment Rail Initiative, or to Saudi Arabia, which is opening vaulting facilities with China. This is about breaking the West's paper pricing monopoly. The COMEX and LBMA have dominated for decades purely because settlement was mostly fictional. 99% of trades never demanded delivery. That game is ending. You can't run a fractional reserve system on gold derivatives forever when serious players start calling your bluff. Look at what the ECB just admitted in their own May financial stability review. They warned that gold is now a systemic risk to the Eurozone because of the sheer volume of over-the-counter gold derivatives that are not centrally cleared. In other words, the ECB is telling you outright that the gold paper game could collapse the system. That's as close to an official admission as you'll ever get. Meanwhile, China is quietly preparing to set the global price. They've already opened up the Shanghai Futures Exchange to direct foreign participation. No more setting up dummy Chinese entities. That means Western banks can trade there directly. It's a huge step toward pulling liquidity and pricing power east, and they're opening new vaults outside China, first in Hong Kong, then Saudi. Why? So settlement can happen in yuan or gold, completely bypassing the dollar. Think about what happens when China finally pulls the curtain back on how much gold they have accumulated. Most analysts think the PBOC's official 2,200-ton figure is a joke. They probably have closer to 20,000 tons squirreled away across state banks, the PLA, even the communist youth leagues. One day they'll reveal it, probably when the dollar's already in free fall, and announce a yuan partially convertible into gold. That's when the whole global game changes. You think the BRICS are disorganized? The moment China pegs the yuan to gold for trade settlement, you'll see half the world line up behind them, because countries like Turkey, Iran, Brazil, and even South Africa want out from under the weaponized dollar. They've seen what happens when you cross Washington. Your reserves get frozen, your currency attacked. Gold neutralizes that risk. That's why central bank buying of gold has hit record levels the last 3 years running. It's not just Russia and China, it's Poland, Singapore, Thailand, India. They're all preparing for a different monetary regime. Meanwhile, retail investors in the West are still chasing Nvidia and meme coins. It's a colossal mismatch in priorities. And one more point, the miners. I know everyone loves to hate the miners because they've underperformed for years. That's normal. Miners always lag the underlying metals at first. Then in the final acceleration phase, they outperform dramatically. If you chart the spread between GDX and gold, or between SILJ and silver, you can see we're right on the edge of a breakout. All it takes is a sustained move in the metals for capital to flood into these ridiculously underowned equities. Remember, miners are tiny market cap-wise compared to global capital pools. It doesn't take much flow to ignite them. We've spent this entire bull leg climbing the wall of worry. Endless calls for corrections that never came. Endless reasons why this time gold is overbought. Meanwhile, the fundamentals have only grown more supportive. Soaring sovereign debt, geopolitical fragmentation, a looming pension time bomb, and a brewing commercial real estate disaster that's going to shred regional banks. This is why I believe when we finally hit that tipping point, when the T-bond market has its moment of panic, when people realize there is no safe yield left, gold isn't going to stop at 4,000 or 5,000. It's going to keep climbing because there will be no policy lever left to contain it. And silver? Silver will do what it always does. It'll go absolutely vertical. But this time, when gold's at 8,000 and silver's at 200, I don't think we get the classic blow off top. I think we transition into a new reality where precious metals are remonetized, either officially or unofficially, simply because people won't trust anything else. That's the ultimate irony. After a century of central banks trying to rid the world of gold's discipline, they'll have to embrace it again. Not because they want to, but because markets will force them. So if you're watching this, here's my message. Don't let the volatility shake you out. Don't listen to the endless predictions of sharp corrections back to levels that make no sense. Every major dip for the last 3 years has been shallow and short-lived. This is a secular bull market in real money, driven by structural failures that no central bank can paper over. In other words, stop thinking in terms of when do I sell, and start thinking in terms of how do I protect what's mine for the next monetary era. Because when this thing finally shifts, it's going to be overnight. The price action we've seen so far is just the warm-up. And if you want a little humor to wrap it, I keep an old Weimar 10 trillion mark note on my desk. Every time someone tells me gold is a relic, I wave it at them and say, so was your last currency.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.